Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordeurn. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Stephen Miran, the chair of the White House Council of Economic Advisers, joins us now for more. Stephen, welcome back to the programme, my friend. Let's talk about the president's message for House Republicans a little bit later this morning. What's top of mind?
Good morning. Thanks for having us. Well, what's top of mind is the Council of Economic Advisers just published a paper. It's available on our website talking about all the good stuff this tax bill is going to do. It's going to boost GDP relative to not passing the bill by about 4.2 to 5.2%. It's going to create 7 million jobs, and it's going to boost take-home pay for a typical family of four by $8,000 to $13,000. So these are really big effects relative to not passing the bill. It's imperative that we get this bill over the line.
Steve, though, when I'm talking to individuals in Congress and then reading your white paper, you have a 15% corporate tax rate in your white paper. Right now, that's not being discussed in Congress. Do you think the president is going to bring that issue forward today?
You know, I can't prejudge the outcome of exactly what these talks will do, but that 15% corporate rate on domestic manufacturing will help at the margin, but it's not the core of the proposal. Those numbers that I gave you will be pretty similar if that doesn't make it into the final version. Maybe it'll be a hair lower, but you have to keep in mind there's a lot of stuff going into this bill, and any single one of these measures isn't enough to sort of change those numbers a lot, because all these measures combine together to improve the investment opportunities in America, to encourage firms to invest, to encourage firms to invest in new equipment, new factories, all this stuff.
There's a ton that's going into this bill, and that is why it's even so challenging for Speaker Johnson to get all these different factions on board. Something else you don't have in your paper, though, is what's going on in SALT. Do you expect the SALT cap to raise, say, 30K, 40K?
Yeah, so I do expect there to be SALT relief. The president has expressed support for this, and I think the president will deliver SALT relief to American households. I don't know exactly what the number will shake out in, and as you know, this is how negotiations happen. One side says what it wants, the other side says what it wants, and the president is one of the best negotiators in history, and he's shown over a career spanning decades that he can forge hundreds of deals, and I think he'll forge another one right in front of us now.
There is a good element in this, that you're focusing on growth, and I do think that is important. You can't cut too much. You have to offer some sweeteners to keep growth going, to keep the revenue side of things going. I do wonder, though, how much of a constraint the debt side really is, given the fact that looks like things are getting a little yippy again in the bond market.
Thanks. So I'm so glad you mentioned that, because the truth is that we do have a plan for deficit reduction and we will deliver lower deficits. It just happens that some of those things fall outside of the scoring process, how CBO scores the bill, because of the rules that Congress gave it. And so, for example, we're going to get better growth as a result of this bill, as a result of deregulation, as a result of the trade deals we're negotiating. We get growth to 3%. That generates $4 trillion additional revenues over the 10-year budget window above the CBO baseline. That doesn't go into the scoring process because CBO doesn't account for improvements in economic growth. We're going to bring in hundreds of billions of dollars of revenue through tariffs, right? That's another point off the deficit. We're going to bring interest rates down through expanding the supply side of the economy, through more effective tax rates, through deregulation, through pushing the supply side out to meet the demand side. We get interest rates back to where they were pre-COVID. That's another point off the deficit. And then there's cuts to waste, fraud, and abuse, some of which are in the bill, some of which are being accomplished by DOGE. That's another 50 to 100 basis points off the deficit worth of GDP. So I just gave you 3 to 4% of GDP off the deficit. None of it falls into the scoring system that the CBO is doing. And yet the conversation is for some reason dominated by CBO.
Well, part of the reason why it's not being scored is because there are a lot of contingencies before you get to all of these realities. And I'll just pick out one, since we were talking about the bond market, the idea that yields go down as you increase the supply side of the economy. There's a pretty bumpy path to get there. Do you have enough faith in that you ignore USGG 30-year index GP, that you ignore the 30-year yield, you ignore the 10-year yield in the near term, and just have faith that longer term it'll work out?
Yeah, so look, we're still dealing with the lingering inflation pressures due to President Biden's reckless fiscal policies, but we are bringing those inflation pressures down through pushing out the supply side of the economy. We've had now 3 inflation reports in a row below expectations. Core inflation on an annual basis is running the lowest level since March of 2021, and as we continue to control inflation, it will provide scope for interest rates to come down. I have no doubt about that.
Well, Steve, the American people are concerned about prices going up. The latest being Subaru. They're going to be increasing their vehicle prices, citing, quote, market conditions, aka concerns about what's going on with trade and tariffs. How can you say you're delivering on inflation when actually companies are warning that prices are going higher?
Yeah, so look, imports are only 14% of the economy. The ability of those types of things to really move the needle on inflation are limited. And what we saw in the tariffs in 2018, 2019 was zero macroeconomic evidence of inflation. What we've seen so far since the tariffs have been, and don't forget, we've been introducing tariffs since day one of this administration. And what we've seen as tariffs have started to come up has been no real meaningful macroeconomic effect on inflation. And so while there can be volatility in the short run, I do believe that U.S. importers have flexibility about where they get stuff from. They can make stuff at home. They can import from other countries that treat us better, that rate trade deals with us, as opposed to countries that treat us worse. And that flexibility gives them leverage. That leverage allows them to force the burden of the tariffs on the other party, on other countries. Now, in the fullness of time, that'll happen. But in the short run, can there be volatility in prices and economic activity, just as there were in financial markets? Yeah, it can happen. But over time, we have the leverage, and that'll allow us to force the burden of the tariffs onto other countries.
When you think about tariffs, do you think they're going to be revenue raising, or do you think that we're going to get deals so the revenue raising won't be as high? And do you have a number within the White House that you're discussing, which how much you want to get in terms of revenue raises to offset this tax bill?
Sure. So first of all, what we've seen with some of the deals we've made so far is that there's still a 10% tariff in place. And in the case of China, there's other tariffs too, the fentanyl tariffs, the tariffs from the first term as well. And so even if we strike deals, odds are we'll still be collecting some tariff revenue. But even if we end up bringing those tariff rates below or down to zero, that means more economic activity. If we're writing deals because we're succeeding in opening foreign markets to our exports, allowing American firms to sell into foreign markets the way we allow foreign firms to sell into our market, that means more economic activity here because of more exports. And if there's more economic activity, more exports coming out of America going to foreign markets, that's more income that gets taxed at the personal level, at the corporate level, and that's lots more revenue too. So either way you slice it, we get revenue from tariffs or we get revenue from higher GDP because we're selling more to other countries.
Sounds like win-win, Stephen. Let's hope it ends up that way. Stephen Miran there, the White House Council of Economic Advisors Chair. Joining us now here in New York City, the former World Bank President, David Malpass. David, good morning.
Good morning, John.
More than a decade of warnings. August 2011, Standard & Poor's. August 2023, Fitch. May 2025, Moody's. We've ignored them for the best part of a decade. Should we start paying attention?
Absolutely. The fiscal situation is a real mess. I've written about it that the spending is out of control. So the question is, how do you bring control to a Washington that really wants to grow? The lobbyists right now are in seventh heaven because of the complexity. And so you have this system that is able to borrow and tax like crazy. And so then Washington sees that and says, we should just spend double whatever we can bring in. And that's what they're doing. Now, whose fault is that? Everybody wants to point fingers at everybody else. I think we've got to see a fundamental change in the spending system. DOGE started that, and now this reconciliation bill is the extension of that and enactment into law. Notably, it includes regulatory reform, which is going to help a lot with growth.
But David, until Washington decides to go and really look at Social Security, that's the biggest piece of the pie when it comes to the spending. Really, everything else is on the margins. Is this administration willing to go there?
I don't think so, and I don't think they should. I think you have to build credibility with the public. Why would you go after Social Security? People put their money into it, and then retirement is a really important part of people's lives and their children's lives as they watch their parents.
But shouldn't the age be raised?
Don't do that.
Shouldn't the age be raised for Social Security?
I don't think it's timely for that question to come on. You really have to show that you can cut some programs, downsize government, and set up a system where you actually make decisions. So they're arguing about the fraud and waste in Medicaid. I think that's a useful discussion of how can you get quite a bit of savings from a program that was expanded drastically.
You talk about how this administration has to have trust with the constituents. Well, the president promised a number of policy provisions on the campaign trail, lifting the SALT tax, which was capped under his first administration, making sure that things like he did say he doesn't really want to touch Medicaid, definitely doesn't want to touch Medicare. How do you build that trust if these are some of the issues that are on the chopping block?
I think by going to the Hill and talking with members, but then also clear communication from the administration and from all around the country of people saying we want the government to stop spending so much money and then make decisions and I've advocated start with small decisions and then make them bigger and bigger. Sometimes I've talked about it that you need to make 3 major spending decisions per week all the way through 2025. And so I think they're doing that some in this reconciliation bill. It's really long. I don't know if you've looked at the bill, but it's intensely complicated.
Well, you talk about that and how it's a daydream for a lot of lobbyists. I am wondering if you speak to people in Washington, D.C. and get a sense of what kind of constraint bond yields are at a time where bond vigilantes are getting very excited.
I think that was the big issue at the beginning of the Clinton administration. You know, spending had been growing, and so you had the idea that I want to be reincarnated as the bond market because it's so important. I do think we've changed a lot since then. For one, the Fed is buying lots of bonds, so that changes the dynamic in the bond market. The U.S. economy is fundamentally really strong, and so I think we could have lower interest rates on the short end and the long end if they could begin to think about the spending side and actually pull it down. So I'm not one that thinks there's so much a limit or a higher yield that we're going to have to see. I think more we have to see the growth come out of the regulatory changes.
How much are you advocating for monetizing the debt in some capacity, given the fact that the Fed is buying bonds, albeit at a slowing pace, and has been known to do that?
You know, I'm not a fan of QE. So since the beginning, I've said it was a shift in duration. The government was basically buying duration to cover up the lack of growth. And that took us from 2010 all the way through 2021. So a giant problem. But that it's correctable. It's not a big step for the U.S. Fed to say it's going to downsize its portfolio. That would reduce that problem. That's already going on in Europe. Look, the ECB is selling off its bond portfolio or reducing the size of its portfolio fast, and it hasn't hurt their yields. And so I think that's a lesson. So that shouldn't be the issue. Right now the issue is the Fed is huge. It's doing regulatory control. It's not talking much about spending. It didn't talk during the Biden administration about the blowout in spending. And the interest rates as a result end up being higher than they should be. The models within the Fed are not working at all. They're based on their 50-year-old models, economic models of how the economy works. So that needs to be really rewritten.
It's been ridiculous for quite a while. Running a 6% budget deficit
thank you.
with unemployment close to 4%. Just absolutely ridiculous.
And everybody knows that. And then they say, well, my politicians should stand up and go after Social Security. That's not really the answer to me. You've got to make
suicide.
Name programs that we don't need. The public will support that and then build on it. And there's some of that in the reconciliation bill. It's good to have President Trump engaged on it.
David Malpass, it's good to see you, sir. As always, as David said, the system is so large in Washington. You start to push against it, it pushes back pretty quickly.
And that's the reason why we've seen year after year people say the same issue and never remedy it, because it is political suicide.
Let's stick with the economy. Torsten Slok of Apollo writing, the list of headwinds is growing. The trade war is making products more expensive in Walmart. Student loan payments are restarting. And the Moody's downgrade is pushing up borrowing costs for consumers and for firms. Torsten joins us now for more. Torsten, good morning.
Morning.
A lot to worry about. And Fed officials just told us to take summer off, basically. That they'll get back together in September and consider what to do. Do you think they need to do something before then?
I don't think they need to do anything before, but I do think that the list of worries is indeed growing. It used to be the case for the last several months that we've been worrying mainly about the trade war. What is coming from the trade war, very importantly, is what Jamie Dimon pointed out yesterday, namely that now we're going to see the negative effects of tariffs on earnings and therefore also on the economy. The Yale Budget Lab is quantifying that the impact on GDP this year will be minus 0.7. Normally GDP growth is 2, so if I subtract minus 0.7, that brings me to still 1.3. That's not a recession, but it's certainly something that will be pushing the unemployment rate up in the same calculation by roughly half a percentage point. So the first thing is tariffs. We are still waiting to see the actual effects of tariffs, both on earnings and on the economy. And the things that are being added now more recently is student loan payments are restarting, is beginning to hit people's credit scores. There's about 9 million people now who potentially will have a hit to their credit scores and therefore will have challenges going out buying a house, going out buying a car, going out buying a washer and dryer. And third and finally, the downgrade. Yes, the market reaction yesterday may be more mild. And yes, we did go from the US being hyper-exceptional to just being exceptional. But it's certainly a risk with the fiscal discussion and in rates markets that we are also adding on to the layer in terms of the issues that we're talking about.
You see this stress in the buy now, pay later data as well. And you've seen that build for a number of months. The question I would ask, the brutal reality is low-income workers haven't had a good run for a long, long time. That's been true even when people came on this program and said the economy was good. Do you see the stress migrating up income levels at all?
That is exactly what's going on. So you saw Klarna yesterday say that they were reporting that buy now, pay later was seeing more weakness among consumers. And the issue is exactly that it's migrating up towards middle-income households. You're seeing this also more broadly in, for example, in the housing data. The Sonda weekly data for traffic for home builders is beginning to slow down. And this spring selling season has basically been much weaker than the spring selling season we've seen for the last few years. So also the weakness in the housing market is a leading indicator telling you that the middle-income consumer is also beginning to look more stressed.
So you don't necessarily see recession, but this downside to growth that comes at a time of pricing pressure, something that looks a bit like stagflation. And I wonder, some people say, well, if it's not a recession, then it's pretty good. Is this actually a worst case scenario for risk assets because there isn't a very obvious reaction function from the Federal Reserve, from policymakers to respond to the fundamental underlying weakness in consumers?
Exactly, because inflation, if that is now going up, we've heard all the stories from Walmart, now Subaru, various, of course, retailers are saying prices will be moving higher over the coming quarters. That's what everyone expects. This is a textbook definition of a trade war, namely higher prices because imports of containers that come in to Los Angeles, of course, things will become more expensive. And that is exactly challenging the Fed's room for maneuvering because they will have to keep rates higher for longer in response to almost no matter what growth is doing. If growth, of course, gets into a deep recession, they will be cutting. But if growth is just weakening, and that is the expectation from the consensus, that's what we're seeing in the data, then you will have this stagflation situation, which is very uncomfortable from a Fed perspective because inflation higher for longer says the Fed should be hiking, but growth slowing down says the Fed should be cutting. So this becomes a question for the Fed. Do they like apples and oranges? Do they put more weight on inflation being high, or do they put more weight on growth slowing down?
So it goes to something that John was talking about, Jamie Dimon yesterday, talking about this complacency in markets, particularly with risk assets, given the fact that, yes, you have these tariffs, but you also have this kind of backdrop that does pressure the consumer. Do you think that risk assets really are not pricing in this type of backdrop at a time when you've seen big rebounds in this wake of any kind of sell-off?
I think the stock market is backward looking at the moment. The stock market is not taking into account the fact that we have these three different forces that are now pushing the economy down. First of all, we have tariffs weighing on earnings, tariffs weighing on GDP, tariffs pushing the unemployment rate up. We have also student loan problems that will hit people's ability to borrow. And finally, we also have the Moody's downgrade. Yes, again, that might just be a thing in markets where we said, oh, this just went and came away and well, suddenly no longer an issue. But it is certainly something that this conversation, the direction of travel when it comes to the fiscal discussion is only one way, namely that we will see debt levels go up and there's more and more discussion around what does that mean, not only for rates, but also for the dollar. And note also yesterday, by the way, that the dollar went down, even though rates went on a round trip, still telling you that there is something here to think about in terms of the bigger picture, not only in terms of what rates are doing. And then when the dollar goes down, of course, we get even more inflationary pressure, and that complicates the job for the Fed even further.
Torsten, you keep talking about downside risks. Do you see any upside risk to policy proposals right now in Washington?
I do think that the stock markets focus on deals when it comes to trade deals. We do see, of course, that there could be some good chance that we could get some deals, of course, over the coming weeks and months ahead. But the issue here is that the policy has already been implemented. Let's not forget
but it's
that
on pause.
But average tariff rates went from in January 3% to now 18%. So that's a fairly dramatic shock. Remember in 2017-18, in Trump's first term, tariff rates went from 2 to 3. And now we went from 3 to 18. That's a very significant impact, which is exactly why this earnings season gave this outcome that companies are having a hard time giving forward guidance. Companies are having, of course, a lot of challenges with dealing with higher tariffs. That's why Ford Motor Company had losses of $1.5 billion, Apple losses of $900 million. It really is significant how these coming motions of what will happen to earnings and GDP are not being priced into markets at the moment.
In your office, at your headquarters, on the calendar, what's circled? What dates? Which month?
So what's most important is back to the square, the circle, to what you said about the Fed meeting. It is very important how the Fed communicates about this. So far, FOMC members have said we have a wait-and-see mode, because it's fair to say, John Williams said this, and Powell also has been talking about this, it's fair to say, let's wait and see what the data actually is going to turn out like. But if I turn on my Bloomberg screen and type ECFC, go and look at what is the consensus expectation to inflation this year, it's going up. What's the consensus expectation to GDP growth? It's going down. As an investor, this should be the number one thing to look at when I do asset allocation. So the answer to your question is the incoming data, does it play out as the consensus and the textbook would predict, namely that inflation is going to go up and GDP is going to go down? And I would expect that is exactly what we're looking at over the next several quarters.
Inflation short-lived or persistent? They say they need time. New York Fed President John Williams said maybe by September. Is that enough time to know whether it's one and not the other?
Well, hold on. So there are two very important aspects of that. Beth Hammack said in a speech here 2 weeks ago at the Hoover Institution that she is already seeing companies that are not impacted by tariffs also raising prices because competitors are raising prices. And the second thing also, let's think about it the following. If it ends up being the case that you will have imports that are significantly lower and therefore you will have less variety on the shelves, that means that I may not be able to buy a white shirt and a bright color, and if that's the case, then the price of all the shirts that are left will be going up. So that means that it's not only about this one-time lift in changing the sticker and what is the price of my shirt, but it's also that if there is less variety, if there's less goods coming in, and if we're trying to avoid and prevent goods from coming in, it will mean that the goods that are left might see a more permanent increase in inflation. So that's why this is not just a temporary feature in terms of thinking about inflation. It is something that potentially could have more longer-lasting impact.
Just don't buy a grey shirt. I can't stand a grey shirt. You know, it's that.
White or blue?
When men wear grey shirts, I just find no one makes a grey shirt look
it's
good.
It's because your ties are grey.
No one makes a grey shirt look good. It's not the tie colours. Sometimes just like white shirts look sharp. That light blue looks sharp. Precisely.
Yeah, it's sort of like.
It looks dirty.
Yeah, it looks like.
There we go.
I don't know.
Cleanest shirt.
Torsten, it's good to see you. Torsten Slok of Apollo. Thank you, sir. Priya Misra of JPMorgan writing the tax cuts will get extended and the spending cuts won't likely happen. Fiscal term premiums should rise more, steeper curve, higher cost of capital to create dispersion in growth and returns. Priya's with us around the table. Priya, good morning.
Good morning.
How much risk is in the so-called risk-free asset?
So it depends on what you define by risk. Credit risk, there is no credit risk. I mean, the US issues fiat currency, we will pay back our debt. The duration risk, which is really a function of term premium, or I don't want to bond geek out here, but risk premium, that's much higher. So you're looking out the curve. There's a lot of risk in those 10-year, 30-year bonds. I mean, look at Japan. So I think if there's a global rise in rates, if we're ignoring, I mean, I think the whole Moody's downgrade, we knew about it. It was lagging, I hear you, but, you know, in the words of Hemingway, you know, how do you go bankrupt? And not that I'm saying that the US is going bankrupt, but, you know, it's gradually and then suddenly. And I think, are we at that point where the market says, you know what, we have to look out for fiscal sustainability. Congress is is not doing its bit. So the bond market has to force Congress to do its bit. And so I think that's why the long end is scary, because how high do rates have to go before the administration or Congress says, you know what, we don't have the political will, but the market's forcing our hand. I'm not sure what that level is. I don't think the bond market is very beautiful right now. It's in the yippee state. So, that's why I think when you ask about risk, the long end has risk. The front end is being dragged with the long end. That's where I think there's opportunity, because we're trying to move away from trade, but we're still in that pause. Effective tariff rate is still high. There's uncertainty. I think the Fed will be late, but at some point they're going to cut a lot, more aggressively when they start. So the front end, I like. The long end, that's where that risk comes in.
Let's unpack some of this. You used an important word, global. It's global. What's making it global at the moment?
So some of it is, I think, U.S. rates do tend to drive the rest of the world. I think there's some element of that. We've seen it in you look at the taper tantrum. Even when it's a U.S. domestic issue, you do see that impact because investors are global. But the other thing is the rest of the world, if the U.S. is forcing the rest of the world to do more fiscal stimulus, either because of trade, defense, you name which issue, you're going to have a lot more supply in the rest of the world. And then if I'm a foreign investor, I'm Japanese, I can look at the highest Japanese rate, or I can look at the US and say, you know what, I don't even know what's going to happen with the dollar. Maybe the dollar is still overvalued. I'd rather hold the US. So I think when it's a global rate rise, it does tend to have more legs, which is why that, to your risk question earlier, that risk in the long end is higher because this is a global bond sell-off, and I wouldn't fade that. I don't think there's a cross-market trade here. I think it's a steepener trade globally.
Well, just to build on that, and something that Ed Yardeni was talking about, how global bond vigilantes are grabbing their pitchforks and marching into the streets and pushing back against some of the fiscal stimulus and just some of the recklessness, as some people would say, that these developed markets have been with their budgets. How much does the risk, if you will, really lie in the developed markets in a new way in sovereign debt markets that totally upends investing logic of the past couple decades?
I think it is a developed market issue. And I think some of this goes back to, if you see how much fiscal stimulus happened during COVID, it was much more in the developed world. Now, it was not as much in Europe, but we're going to get a lot more defense spending, infrastructure spending. But the US spent a lot of money. Part of that exceptional story was the fact that we had significant fiscal expansion. And now I think the market's saying, no mass. What I struggle with is risk assets are ignoring this. So if things slow down, the Fed is telling us actually very clearly that we're not going to be in there quickly. We might be constrained because of inflation risk. Now the fiscal side's telling you there may not be a lot of fiscal put either. So I think the risk asset complex is a little complacent. But to your point, I think the bond vigilantes are awake. Do they take over? I think it's a bit of a dance between the hard data and the bond vigilantes, and we have to see who wins.
I keep thinking about Ed Yardeni, and he can't decide whether it's going to be a stock market melt-up or a bond market meltdown. And it seems like the risks right now are the potential for ongoing growth, also with inflation and fiscal irresponsibility on one side. So the duration risk is the big one, or it becomes a growth scare. And suddenly the credit risk becomes the key component. Are you saying that the credit risk component, the growth scare, is the one that we should prioritize, which will ultimately cure the other side, at least for most of the duration, in terms of where the risk is perceived?
I think that's like the trillion-dollar question here. I mean, the hard data is going to be so muddied by front-loading. Maybe there's still front-loading happening because we're in that pause period. We're in an uncertain period. I do think if I step back and look at fundamentals, I think we're slowing. We've taken that tail risk of recession off the table. But what is our base case? Below trend growth. And so I do think if you ask me to pick one, I would say the growth side is likely to continue to weaken. We'll be looking at details. Do companies pass on? I mean, this is a consumption tax, ultimately. Whether it's corporates eat it or consumers have to eat it, it's going to start to hurt demand. So I think growth slows down. But to your point, I don't think we can ignore if we get a bill, and it's still not done. The Senate has to work. I mean, I'm focused on the Senate. They don't like even the Medicaid work requirements. So if you get SALT, you get a lot more fiscal stimulus, and we realize it's all front-loaded, then I think you can get that long end. But there is a self-limiting aspect to that long end. Like, I don't know if it's 4.5%, 5%. I think every other market's going to pay attention to it. The economy is going to slow down because the long end is what actually drives the economy. So there's a limiting aspect. I just don't know if we're there yet. And if the hard data remains muddied and all we get is the soft data, hard data disconnect, you can get the front end being stuck. and the long end taking over. I think that's the risk scenario, which is why, it's nervous to be in the long end. I think you're supposed to have steepeners. And if you own risk assets, you're supposed to buy that front end, because that's the only place where you can have confidence that the Fed can come in and somewhat control.
Priya Misra of JPMorgan Asset Management. Priya, thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.